Welcome back. We're in the Wealth Lounge. I have Mr. Chris Fratta. Appreciate you coming back and taking some time out to speak to us. Today's topic is going to be improving your chances to get approved. Now, this topic I feel is very, very sensitive to a lot of folks because I really think it plays on a lot of people's fear and uncertainty on whether or not they're going to make it through this process. I mean, this entire process, even when you're searching for the home, takes just about, maybe 3 to 6 months, at the bare minimum. And it can even stretch out, further than that when you're really trying to find a home that really fits all of your needs and checks all of those boxes. But one of the biggest fears is whether or not folks are going to get approved. And I'm sure with 30 years in the business, you could definitely shed some light on some tips that would help improve your chances on getting approved. So, I would like to know first, and I'm sure everyone else would like to know, what are some most important factors that a lender considers when approving a mortgage?
So I think to start out with what's important, especially with first-time home buyers, I think it's critical that when you are deciding to get into the real estate market, purchase your first house, is let's address the financial capabilities today. So many times, I think the biggest mistake that especially first-time home buyers make is they get out there with an agent, they start looking at houses before they really know what they can or cannot do. And information is power. So it's sitting down with a professional up front and doing a deep dive as far as what your buying power is. It's going to do two things. One is going to educate the borrower, and that's extremely important to us here at Benchmark, is making sure the borrowers have all the information that's going to be associated with the purchase of that house. We're talking interest rate, costs, programs, everything they're going to go in knowing what they're able to do. And two, once we get past that process, the other advantage of doing that up front is it allows them to really kind of target their search. If we give them a maximum buying power, then they know, all right, we're going to look for houses in this range. Because when you go in a situation, you fall in love with the house emotionally, and you find out that house might be a little bit out of your price range, it's tough to recover from that. So it's important that all the information is up front because it makes the home buying process, the home search process, easier when you have that knowledge up front. Now what I do when I sit down with a client, I look at what I call the 3 buckets, the borrower's 3 buckets of qualification. And those buckets are income, assets, and credit. And we're looking to see how full each of those buckets are. One bucket plays off of another. So when we talk income, assets, and credit, obviously income, we're looking to see if that borrower has stable and predictable income. Because we want to understand, and we want that borrower to understand what they can afford today. But also we want to make sure that borrower is going to be gainfully employed and that income stream is going to be the same tomorrow. So they're not going into a situation where they can afford X today, but tomorrow Y becomes very difficult because their income is fluctuating. So we're looking at stable and predictable income. That's one of the things we look at in that first borrower bucket. The second is that asset bucket. Again, credit, assets, and income all are tied together in the qualification. So for assets, we're looking to see what is that borrower's saving pattern, because that's almost like a form of credit evaluation. If we have somebody who has shown the commitment to put away $200 a month over an extended period of time, it shows that they've got the understanding of the importance of budgeting and managing their money. And that's critical when you're talking about taking on a mortgage, because it's the largest debt someone's going to have. You don't have to be flush with thousands and thousands and tens of thousands of dollars, but that savings pattern is what we're looking to see if they have that commitment. And then finally is credit. Unfortunately in life, we are known by 2 numbers. Our social security number and our credit score. And until someone gets to know the individual, that's all they're known by, those 2 numbers. And we try and get beyond those numbers as far as understanding what that motivation of that potential buyer is, and why are they trying to buy a house? Are they trying to better their lives or better their families' lives? So the credit portion is obviously going to show, are they able to manage their monthly debts month after month? Are they going to pay consistently on time? And you don't have to come in with absolutely sterling perfect credit. But we want to see what the history looks like in the past, and we can predict going forward. And again, the reason why the importance of sitting down with a professional before you actually get out in the car and start looking at houses is because you might not be ready just yet.
Yeah.
And that's okay.
Yeah.
That's okay. Our job is to put down a roadmap when we do that consultation. And typically when we have that roadmap, it usually revolves around the credit themselves. Mm-hmm. So we're looking at that credit report, we're evaluating what that credit report looks like, and we're trying to identify any potholes that potential borrower may run into during their home search. So we're going to address those. So if you're not ready today, still talk to a mortgage professional, because we're going to look at this, analyze it, and we're going to kind of give you a plan that we can maybe improve the situation. So maybe 6 months, 8 months down the road, if you're not ready now, we can get you in a position to be ready then.
I absolutely love the way you phrased that, right? No, there's never a no, but there's always a maybe not yet.
Correct.
And you follow that not yet up with a timetable, mm-hmm. right? Where, you have actionable steps that you need to take from a professional, taking you directly to where your target is. Right. I absolutely love when you phrase that. But let's stay on the credit topic. Mm-hmm. With that being such a huge portion of the decision on whether or not they're going to be approved or not, what are some steps that a applicant can take prior to the mortgage application process or the approval process to get their credit in order to make sure that they're in the right area to get approved?
Well, first, everybody should be accessing their credit report at least once a year. Not necessarily to know what their credit score is, just to make sure that the debts on the credit report are their debts, their identification hasn't been stolen. So just monitor your credit at least once a year. When you're prepping to buy a house, one of the things we're looking at is income and credit itself. Mm-hmm. So don't continue to apply for credit cards. Don't take all these offers that are always given, mm-hmm. because part of that algorithm, which creates the credit score, determines whether that borrower is someone who's constantly and actively seeking new credit. Mm. If you are constantly actively seeking new credit, then that algorithm determines that this is a person who is potentially a red flag individual, because they could get to a position where that credit becomes too much to handle. So limit the amount of debts that you're taking on. Look at the debts that you have. And this kind of is a tough thing to do, because we're talking about creating savings for down payment, but also managing credit. Mm-hmm. So, and they work hand in hand. So when you're pulling that credit report once a year to kind of see where your credit position is, look at the revolving credit debts that you have and try and pay off the balances that have the highest payments with the lowest balances there. So if you can knock out those small balances and eliminate those higher payments that way, you're going to see some improvements in your score. But the other part of it is, when you do pay those small cards off, don't close your credit card. Stick it in your top dresser drawer and leave it there. Mm-hmm. Because one of the things about your credit score, and again, when we're driving, we talk about the Social Security numbers and the credit score numbers. One of the things that drives credit scores, for people who don't understand, is not just how frequently you pay your debts on time, but how much debt you have. There have been so many instances in close to 30 years where we've pulled credit reports of borrowers who, for the most part, have never missed a payment in their life. Mm-hmm. But the credit scores aren't as high as you think they would be, because their credit balances are so high compared to the credit limits. Right. So when you're prepping yourself and trying to get ready, try and get to a point where your credit card balances are less than 50% of their maximum credit limit. So if you have 2 credit cards that have $2,500 balances, mm-hmm. you should not be carrying more than $2,500 of combined debt. Once that number starts to tip over 50% of your available revolving credit, that algorithm starts identifying that person as a potential credit risk, mm-hmm. and that starts to drive that score down.
So guys, we got to be paying attention to our credit usage, because your utilization rate, which we had talked about before, can get kind of high on you. And as you just heard, lenders really do put a lot of weight on that, depending on what the reflection of your credit score is. All right, so let's say credit's good, and I'm ready to start looking, so I'm coming to you to come, to be pre-approved. I know that 20% is not always the end all be all.
Sure.
But what is the amount that I can put down that kind of increases my chances to be approved?
It varies from individual. I think we've spoken in the past that this is not a cookie cutter transaction. Things are different from each borrower's situation. Typically, when you're talking about minimum down payment, they're going to range between 0% and 5%, depending on what type of program that borrower is going to go for, whether they're doing a VA loan, which is a 0% down loan most of the time. Conventional loan can be anywhere between 3 and 5% minimum down payment. And FHA is typically a 3.5% minimum down payment. So when you're talking about, does a larger down payment increase the borrower's chances? Sometimes yes, because we look at those 3 buckets, income, assets, and credit. Sometimes if we fill one bucket a little bit higher, it will compensate sometimes for some of those buckets that aren't quite as full as we like them to be. Which again is why it's not the same story for every single borrower. So we want to see that consistent savings pattern. We want to see if the borrowers have the ability to save that minimum down payment. But there are many, many borrowers that we work with who, through some of the down payment assistance programs that we have, they're purchasing homes with as little as $1,000 out of their pocket. So you don't need 20% to buy a house. You don't need 10% to buy a house. You just need to make sure you're moving towards the right mortgage program that's going to fit your budget, fit your needs.
And it sounds like, and you keep hinting toward every situation being unique. And it just sounds like you need to be reaching out to consult with a professional to make sure that your specific situation can, you can get some options for. Okay, so let's say I'm in the beginning of the process. I'm getting ready to come to you. Credit's good. What sorts of documents do I need to be ready to present to you to get my pre-approval as quickly as possible?
So I call it, the basis of documentation we're looking for is the 2 plus a photo ID. That's going to be for every borrower that comes in. And 2 and a photo ID represents 2 most recent W-2s for the last 2 years, 2 most recent pay stubs covering the last 30 days of employment, 2 most recent bank statements, all pages, all accounts, covering the last 60 days of banking activity, and a photo ID. Those 4 things are going to give us the basis of pre-qualification and pre-approval. Now, there are instances where you may be self-employed, or you may have variable income, or you may have seasonal income. So we may need tax returns, personal returns, business returns. If you're not in the workforce for a full 2 years and you were in college, then we'll need transcripts to get that 2-year gap. But for the most part, everyone should be able to supply the last 2 years worth of W-2s for all employers, 2 most recent pay stubs to cover the last 30 days of employment, and 2 bank statements, all pages, all accounts. Even the bank statement page, that's just a reconciliation page. If there says 1 of 6, we need to see 1 of 6 pages.
All right, make sure you're tapping into that, guys. All right, so let's say I brought everything, credit's good, and things are looking up for me.
Right.
I get into this process with you. I'm looking forward to my consultation. Let's say I get my pre-approval letter and I'm looking. What are some things during my search, even though I'm pre-approved, that could disqualify me from actually purchasing my home?
Opening new debt after the fact. Especially if you're pre-approved. One of the things that we always find, especially with first-time home buyers who are trying to find their first house, which means they're trying to furnish their first house. They're excited. They're thinking about that 65-inch LCD TV. They're thinking about that big sectional sofa. So once we do the pre-approval process, you have got to stop spending your money. If we pre-approve you with X amount of dollars saved and a credit score of Y, you want to try and maintain or improve those numbers. When you're out there acquiring new credit, you could be shooting yourself in the foot and not even knowing it, because we could pre-approve you on today, and it may take 60, 70 days to find a house. And then you're looking at another 30 days to process the mortgage. So if you're picking up new debts in between the time of our consultation until your time you have a ratified contract to the time of closing, you could really flip your financial picture from an approval to a picture that needs a lot of work. Don't abuse your credit.
Make sure you are not applying for new credit, guys. Don't go buy a car just because you're pre-approved. Don't go get your sofa.
We get so many calls, and because they're excited. Hey Chris, look, I want to buy that living room furniture. I know we're closing in 2 weeks. And I say, Ryan, look, don't purchase anything until we issue the clear to close. Once you get your clear to close, then we pop everything in cruise control, and we're just waiting for that day for the final signing. But err to the side of caution. Don't spend your money prior to closing. Don't spend your money before contract, and don't open up any new credit.
Okay, so this actually stretches into, let's say I get my contract on a home that I just know that I'm going to want.
Right.
And I'm in underwriting, and I'm looking forward to this pre-approval or this approval to close. You're saying do not apply for new credit all the way up until I'm cleared to close.
Once we pull your credit report, we have monitoring systems in place. All mortgage companies do. So if I pull your credit report on June 1st and you're supposed to close on July 15th, if on June 20th you take out an interest-free credit card to furnish your living room, we're notified. Hey, Ryan Dunstan has opened up a new credit with big screen TV. We then have to get from you all that paperwork showing what you purchased, what that minimum payment's going to be, and we have to calculate that payment back into your debt to income ratio, which means we have to go back into underwriting and look at that. So if we're sitting at a 45% debt to income ratio, which I'm sure you've explained in the Wealth Lounge, your debt to income ratio is your gross monthly income. That's going to be dedicated towards the proposed mortgage payment plus all your minimum credit card and other installment loan payments. If that number is sitting at 45% and you're approved and you pick out a new debt, and that's 110, it could be as little as $30 a month, and it pushes that debt to income to a point where the automatic underwriting system is not comfortable, we go from an approved loan to now we're scrambling in the 11th hour to get it fixed. So do not open any new debt once we pull that initial credit report.
Make sure you are not open. I'm going to say that for a third time. Do not open any more credit until you have your clear to close. Okay, all things are going well. I want to know, what is it that I can do within my process to help or assist you in my pre-approval? Meaning, let's say I have my contract and everything's moving along. What do I need to be doing, or how could I assist in my pre-approval or in my approval?
The thing that I find that moves the process the smoothest and the most efficient is to make sure you're communicating borrower to mortgage banker, banker to mortgage banker. And there has to be a sense of urgency with the process. Typically, you're looking at 30-day contracts. Well, we see contracts sometimes as short as 21 days. We see contracts 45 days. And the thing about the length of the contract, regardless of how long or short it is, that closing date comes up quicker than you realize. It's there. Things start moving in motion pretty fast when that contract goes live. So it is important as a borrower. If I call you and say, hey Ryan, the pay stub that you gave us was not legible. I need you to send me another pay stub. I'm going to give you a drop dead date. If I call you at 12 o'clock today, I'm going to say, Ryan, I need this pay stub by noon tomorrow. And if you don't have that pay stub available by noon tomorrow, I'm calling you at 11. I'm calling you at 1 o'clock. I'm calling you at 2 o'clock. I'm calling you at 3 o'clock. If it goes another day, I'm calling you and I'm emailing you and I'm CCing your borrower. And I'm not trying to be a tattletale, but the urgency has to be understood because this is going to move fast. And once you enter that contract, you are committed, and you're committed to fulfill that contract with a successful closing. So to make this smooth and pleasant, we just have to make sure we communicate. And whatever documentation is needed, you need to get it in a timely manner so we can move forward as well too.
Your response time, guys, it helps with the process. It helps streamline things, specifically when you're up against that timeline. Because again, 45 days goes by quick. I mean, if we all, I can think back to when I was a child and say to myself, man, time flew. My son just graduated high school. I said to myself, man, I remember when you were in diapers. So 45 days, blink of an eye, I'm sure. So make sure that you're keeping that line of communication open so that you can help along, streamline your process a little bit, and you don't cause yourself any delays. Upsetting in some cases the seller, and they could in fact walk away from the deal. But Chris, this has been all valuable information. Lots of golden nuggets have been dropped. Tap in, guys. Tap in. These are all good things to know. Mr. Chris Fratta. I appreciate you joining me once again.
Thanks for having me again. And again, everyone, remember, whether you're ready to buy now or a year, sit down with a mortgage professional, find out where your starting point is, and figure out what that roadmap is, and we'll get you into a house.
30 years of wisdom. Chris Fratta, sales manager and senior loan originator. I'm Ryan Dunstan, your narrator in the Wealth Lounge, and we'll see you next time.
Thank you.